Welcome to today's Explainer. Let's get right settled in. Today, we're undertaking a comprehensive masterclass on what is honestly the absolute most critical planning question in your BPT syllabus. Should a business operate as an unincorporated entity, like a sole trader or a partnership, or should it trade through a limited company? We're going to take this at a very careful, deliberate pace today, because understanding the deep structural mechanics of this choice is absolutely fundamental. It's not just for passing your 2025 exams, though that's obviously huge, but for advising real clients in the real world out there. So here is our roadmap for the session. We'll start with taxing and extracting profits, then move on to handling trading business losses. After that, we'll cover disposals and inheritance tax, practical non-tax factors, corporate structure planning, and finally, we'll wrap up with exam strategy. This framework will logically guide you through every factor the examiner expects you to evaluate.
Okay, let's dive into this. Section 1, Taxing and Extracting Profits, the day-to-day.
Let's examine the side-by-side tax rates, because the contrast here is pretty significant. For a sole trader or partnership, income tax hits at 20, 40, or 45%, plus Class 4 national insurance contributions at 6 or 2%. Now, compare that to a company. A company pays corporation tax starting at a small profits rate of 19% up to a main rate of 25%, with a marginal relief rate of 26.5% in between. I know that's a lot of numbers, so let's pause. Here is the absolutely vital concept to grasp. A sole trader is taxed on all profits as they arrive. It doesn't matter if they spend that money or just leave it sitting in the business bank account, it's taxed. A company, however, it only pays corporation tax on its profits. The shareholders themselves pay zero personal tax until those profits are actually extracted. So you can effectively defer personal tax just by keeping the money in the company. Let those two numbers sink in. 42% versus a staggering 50%. This is a real wake-up call. Think about it. If you're a higher-rate sole trader, your total tax burden on profits above £50,270 is 42%. That's your 40% income tax plus your 2% Class 4 NICs. But if you trade through a company and extract all of those profits out as dividends, well, you pay 25% corporation tax first and then a 33.75% dividend tax on whatever is left. Add that up and it gives you an effective combined rate of right around 50%. I want you to write this golden rule down. I'm going to say this very slowly. The company only gives a better result where profits are retained rather than immediately extracted. If you apply this rule properly in your client scenarios, you will absolutely unlock the core of the analysis. If the owner needs every single penny to live on, going with the company might actually leave them worse off. And this brilliantly illustrates the optimal way to extract profits if you're an owner, director of a limited company. You actually have a lot of choices here. Step 1. Pay a salary right up to the primary threshold of £12,570. Why? Because that gives you zero income tax and zero employee NICs. Step 2. Employer pension contributions. These are brilliant because they're fully deductible for the company and entirely tax-free for the director, right up to the £60,000 annual allowance. Step 3. Use dividends for your remaining cash needs. This avoids the heavy national insurance contributions you'd otherwise pay on a higher salary. Of course, sometimes directors just borrow money from the company, right? But beware of the Section 455 charge. If a director's loan isn't repaid, the company faces a harsh 33.75% corporation tax charge on that outstanding balance. Honestly, it's essentially HMRC's highly punitive way of saying, yeah, nice try. It's really only useful for short-term cash flow, definitely not long-term extraction. And keep in mind, if the loan's interest rate is below the official rate of 2.25%, you've suddenly got an employment benefit in kind to deal with. So we've explored the sunny days of generating profit. But businesses are cyclical. Startups especially frequently face initial struggles. So what happens when the business faces tough times and generates losses? Section 2. Handling trading business losses. Startups frequently face these initial losses, so this is a really vital early years planning tool to understand. When it comes to losses, the unincorporated structure is just the clear winner for flexibility. Look at those unincorporated options. Under Section 64, you can offset losses against general income. And under Section 72, losses in the first 4 tax years can actually be carried back 3 years against total income. This is huge because it generates massive immediate tax refunds, often reclaiming tax paid from a prior employment. Now, a company, on the other hand, uses Section 37, which can only carry losses back one single year, or Section 45A to carry them forward against future profits. Plus, if a company closes down, those unused losses are permanently trapped. An unincorporated business, by contrast, gets to use Section 89 terminal loss relief to carry back those final losses. So we've seen the start of a business and the day-to-day operations, but what about the end game? How do we handle selling the business or passing it on to the next generation? Section 3, Disposals and Inheritance Tax. Now, what's really interesting here is how complex these exit strategies can get. Let's talk about selling the business. For a sole trader, it's relatively simple. You just sell the assets. If you qualify for Business Asset Disposal Relief, or BADR, you pay just 10% capital gains tax up to your £1 million lifetime limit. Easy, right? Now, for a company, a direct sale of your shares is almost always the best route, since BADR, or the Substantial Shareholding Exemption, SSE, can apply there. But be very careful here. If a company sells its assets and then distributes the cash to shareholders, you create a severe double tax danger. The company pays corporation tax on the asset gain, and then the shareholder pays tax again on the distribution. You absolutely must warn your clients about this trap. On the topic of passing the business on, let's discuss inheritance tax. Business Property Relief, or BPR, provides 100% relief from IHT for a genuine trading business. I want to state this very deliberately. BPR applies equally to a sole trader's business and to unquoted or AIM-listed shares in a trading company. Therefore, there is essentially zero inheritance tax difference between the two structures. Do not let a client incorporate purely for IHT reasons. It doesn't make sense. Section 4, Practical Non-Tax Factors. Let's pivot to commercial realities, because a purely tax-driven answer will absolutely fail to address real-world business risks. Let's discuss administration and liability. A sole trader has unlimited personal liability. If the business fails, the owner's personal assets, yes, including their family home, are entirely at risk. A company, however, provides limited liability protection, essentially walling off personal assets from business creditors. Now, sure, a company does come with the burden of complex filing and audits, but crucially, protecting the family home often overrides any tax savings. The taxman might take your profits, but an unprotected commercial lawsuit can literally take your house.
You also really need to evaluate pensions and cash flow. A sole trader is restricted to personal pensions and must pay tax in January and July on account. But a company, it offers incredible pension flexibility. We're talking occupational schemes, SIPs, or a small self-administered scheme, or SSAS, which can literally lend money back to the company or even hold the commercial property the company trades from. Plus, corporation tax is usually paid 9 months and 1 day after the accounting period ends. That offers a massive cash flow advantage over the sole trader's rigid payments on account.
Section 5, Corporate Structure Planning. Let's move to advanced planning and see how this builds into corporate group strategies. Once you're incorporated, you unlock some truly powerful group strategies. You can use group loss relief, you can transfer assets at no gain, no loss, and form VAT groups. You can utilize holding companies to receive exempt dividends, or use alphabet shares for family income splitting. But the absolute most vital structure you must learn here is splitting the trade from the property. I'll explain this slowly. Here's how it works. You place the valuable business premises in a separate property company, and you put the risky trading operations in a separate trading company. The trading company then pays rent to the property company. By splitting them legally like this, you perfectly protect the valuable real estate from the trading company's commercial creditors. It is a brilliant safeguard. Section 6, Exam Strategy and Conclusion. Let's shift from the theoretical into top-tier examination strategy for you all. Applying these exact rules guarantees maximum marks, so listen closely. First, always balance tax with non-tax factors like limited liability. Second, clearly distinguish between retained and extracted profits in your calculations. Third, when asked about extraction, compare all 4 methods: salary, dividends, pensions, and loans. Fourth, explicitly identify the difference between share and asset sales on disposal. And finally, always mention business property relief in any IHT discussion. I'm going to leave you with this final provocative thought to really test everything we've discussed today. If your client walked in tomorrow needing every single penny of profit just to fund their personal living expenses, would you still recommend they incorporate? Keep that dynamic firmly lodged in your memory. Thank you for your focus today, and best of luck applying this framework in your studies.